Hello everybody, Zachary here from Pathfinder Wealth Consulting. Today we've got a special topic in honor of National 529 Day on May 29th. We get a lot of questions surrounding 529 college savings plans, so we thought today we'd put together a Q&A to help answer some of those common questions, talk about some of the myths with 529 plans, and also talk about a few of the changes that have happened recently with 529 plans. So let's get into it. First, what is a 529 plan? A 529 plan is a tax-advantaged savings plan that allows you to save and invest money towards future educational costs. Next, what are some of the tax benefits of a 529 plan? Well, first of all, a 529 plan allows you to invest money with tax-free growth as long as it's used for qualified expenses. In some ways, it's similar to a Roth IRA, where you put in after-tax dollars and that money grows tax-free indefinitely. In North Carolina, there's no tax deduction for making contributions to a 529. However, there are 30 states that do, and that means that you get a tax deduction for making contributions, and also you get a tax benefit on the back end by getting those earnings out tax-free. One of the common questions I get is, why wouldn't I just save for college in a bank account or even a brokerage or investment account? Because of the tax-advantaged investment component within a 529 plan, you benefit from future tax-free growth. With a bank account or a taxable investment account, you'll get a 1099 each year where you have to pay taxes on any investment income, dividends, interest, or capital gains each year. With a 529 plan, you escape any taxes on any investment income, and you get those earnings out at the end tax-free. Another common question is, how much do I need to save for college? This is not a simple answer, but a college savings calculator could help. First, it depends on how much you're willing to contribute for a beneficiary's college. Are you willing to pay for tuition only, or the full boat, which includes room and board, books, etc.? Then you want to target a specific college or an average cost. In North Carolina, the average total cost of college is $26,590 per year. If we look at UNCW, their average cost is $19,204 per year, of which $7,181 goes to tuition, an estimated $10,897 to room and board, and then another $1,126 towards books and supplies. If you're looking at an out-of-state school, count on at least another $10,000 to $15,000 per year in extra expenses. I ran a simple calculation based on 6% inflation of college expenses and a 7.2% investment growth rate. For the North Carolina average cost of college, the full cost, you'll need to save $524 per month when a child is born to get the full cost of college by the time they turn 18. If you were to save this in a taxable account, not in a 529 plan, you'd actually have to save $612 because you lose those tax benefits. In a similar example, if we look at just UNCW, because of the lower cost, if you paid for the full cost of school, you would need to save $379 per month in a 529, $442 per month in a taxable investment account, and for tuition only, not including room and board and other expenses, you'd only need to save $142 per month in a 529, or $165 per month in a taxable investment account. So as you can see, that's a big range of savings requirements based on someone's individual goals. So it's important that you take a look at what kind of school you want to target and how much you're willing to pay for your beneficiaries' educational expenses. The next question I get is, how do I choose the right 529 plan? While each state has their own state-sponsored plan, you aren't required to use your state's plan, which makes it even more confusing. Now, if you're in a state that has a tax deduction for 529 contributions, you will want to use your state-sponsored plan. In addition, there are what's called advisor-directed plans and self-directed plans. North Carolina's, for example, if you use the plan through cfnc.org, that is a self-directed plan, meaning that we as advisors can't set up and maintain one of these plans for our clients. Now, we can offer advisor-directed plans where we can help handle the administrative side and managing the investments. For those, we typically shop around and find the best plan available. Lately, we've been using the Virginia plan, which is through American Funds. In the near future, Commonwealth, our broker-dealer, is rolling out an advisor-directed 529 plan through American Funds as well. Morningstar, an independent investment research company, comes out with an annual guide for choosing 529 plans where they have a rating system based on all of the different plans available within the United States. Another common question I get is, what if my child doesn't go to college? Well, first of all, they've loosened some of the qualifying expense requirements recently that now allow 529 funds to be used for private school as well. And even more recently, you can now use 529 funds to pay off student loans. But let's say you save in a 529 plan for your child and they turn 18 and decide they don't want to go to college. Well, one thing you could do is simply change the beneficiary to another child or even to a future grandchild. If you end up needing to withdraw some of those funds for non-qualified expenses, there's a 10% penalty and income tax due, but only on the earnings. So you always get your dollars contributed back without penalty or taxes. It's only the earnings that get penalized. In my opinion, it's still better to invest in a 529 plan versus putting money in a bank account that might be earning low interest. Another important question is, how do 529 plans affect financial aid? Another common one is, should I have a grandparent establish a 529 for my child instead of setting it up myself? Well, 529s, if owned by the parent, are counted as a parental asset in the financial aid equation. A parental asset has a much lower factor than a student asset or student income. What happens if a 529 is owned by a grandparent? It is excluded from parental assets in the financial aid equation, but any money that is given to the child from that 529 is then reported as student income in the financial aid equation. Student income has a much higher factor, about 5 times higher than a parental asset would in the financial aid equation. So bottom line, having a 529 in a grandparent's name is not always the best idea. Now, one strategy would be to use a grandparent-owned 529 for the last year of college. And that's because the FAFSA or the financial aid equation looks back 1 year, so they wouldn't catch that income until the following year when the child is hopefully graduated. So the last question I get is, how much can I contribute to a 529? Well, in short, a lot. Contributions are considered gifts, and you can gift up to $15,000 in 2020 or $30,000 for a married couple to be under the gift exclusion amount. However, there's a special rule with 529s where you can make a 5-year election, where you can contribute 5 years worth of contributions in 1 year. Now, since this is going to be above that $15,000 gift exclusion amount, you do have to file a gift tax return with your taxes. This doesn't necessarily mean that that money is taxed, but it does have to be reported to the IRS because it goes towards your lifetime gift exemption amount, which currently resides at $11.58 million per individual for 2020. Most folks don't run into that issue. In closing, similar to saving for retirement, by saving more now, you benefit in a 529 because you really benefit on the back end with the tax-free growth. By saving more now, essentially, you'll have to save less over time because you have those investments working for you. But remember one important point. We always say that you can borrow for college, but you can't borrow for retirement. So before you set up a college savings plan, make sure you're hitting those retirement savings first. I appreciate you listening in today. If you have any questions about college savings and how it might impact your financial plan, please give us a call.